Hello, my name is Rolake Akinkugbe-Filani, and I'm currently part of the executive management team at one of Africa's leading infrastructure developers. In the past 15 years, I've worked in research, finance, investment banking, consulting, and international development with a focus on the energy and infrastructure sectors. I also enjoy offering my perspectives in global markets and African business and economic news. Now, on to one of my favorite topics to discuss, global energy. In this video, I'll be giving my take on global energy markets in 2021. So oil price predictions are already rolling in for 2021. Oil prices defined as the average of Brent, West Texas Intermediate and Dubai prices are expected to rise to an average of $44 per barrel next year and $50 a barrel in 2022, up from the expected $41 per barrel in 2020. That's according to the World Bank. While international analysts from banks like Goldman Sachs see 2021 oil averaging $65 per barrel due to the current structural underinvestment in oil and gas, which they say could put upward pressure on oil prices. My safe prediction is around $50 to $55 a barrel in 2021, but it's fair to say that 2020 was indeed a tumultuous market for the industry. It's been no stranger to volatility. We know geopolitical instability was the name of the game in 2020. We also saw price wars between oil-producing countries. Now, add COVID-19, which at its height wiped around 20% of world energy demand off the market and literally brought the world to a standstill. You then had the makings of a perfect storm. We saw free-falling crude oil prices in the first quarter of 2020, and at one point, prices in North America went as low as minus $40 per barrel. We also saw negative prices for crude futures and a global economic shutdown. I think at some point we were all left wondering where the bottom of the hole would be. And there were a variety of responses from the industry. So we saw companies divest non-performing assets. We saw others optimize their investments in mergers and acquisitions. Still others were deleveraging and focusing on shareholder returns and exploring other financial structures. But let's look at the market fundamentals. The biggest weight on the oil market in 2020 was demand, which literally fell off a cliff because of the COVID-19 outbreak. The outlook for 2021, I think, will be a bit brighter. The International Energy Agency anticipates that oil consumption will average about 97 million barrels a day. That's around 5.7 million barrels of increase from 2020's average, or about 2/3 of the lost demand from last year. It also sees robust demand for gasoline and diesel, which it believes will return to about 99% of pre-COVID levels. However, while consumption may pick up and get back on track to close to pre-COVID levels, there's a massive amount of excess supply still sitting in oil storage tanks around the world. There's about 625 million barrels of crude oil in storage than we had before the pandemic. It could take the world economy an entire year to burn off all this excess inventory, giving the IEA's demand projections as well as production estimates for OPEC and other producers. So while demand could recover on the one hand, the supply overhang will likely keep a lid on oil prices in 2021 on the other hand. The current glut of supply will of course mop up much of that incremental consumption, and it could take longer to roll out vaccinations worldwide due to the potential production issues, adverse side effects, trial failures, and some social resistance around the world to the vaccine. And that could, of course, impact recovery in the global economy. And if OPEC does bring back production too soon, that would keep inventory levels elevated, weighing further on oil prices. Now let's shoot over to the US in terms of US President-elect Joe Biden's energy policy. He's touting a transition from the oil industry and putting clean energy at the center of his $2 trillion green plan to decarbonize American industry in 15 years and create a net zero emissions economy by 2050. Now, he's also looking to put the US back into the Paris Agreement, though I think it will take a lot of work for him to do that. So this Green Deal, at the very least, will likely be heavily watered down. The US has also been an active and often an intrusive player in the geopolitics of oil these last 4 years under Trump. Trump famously pressured OPEC and its partners to make capacity available in late 2018 when Brent threatened to soar to around $100 a barrel. And the US has also previously worked with OPEC Plus to do a deal on production cuts in the demand crisis of 2020. And of course, the big elephant in the room, Iran. The Biden administration could return the US into the international deal over Iran nuclear sanctions by executive order without going through the Senate, and has indicated that Iran should comply. So putting all this together and giving all this uncertainty in the global oil markets on the demand and supply side, I think oil companies are taking an extremely cautious approach to 2021. So in addition to cutting investment spending, most oil companies are focused on reducing costs by growing through their scale, through mergers, etc. On a more positive note, though, I believe that some of these cost-cutting moves could actually pay big dividends in 2021. If oil prices improve to around, say, $50 a barrel and these oil companies achieve their cost reduction targets, they could actually generate excess cash in the coming year that could help give them funds to repay debt. So oil consumption should recover most of what was lost in 2020, which, thanks to OPEC's help, keeping back supplies, should actually enable the oil industry to burn off its current glut by the end of 2021. That, I think, will take some of the pressure off oil prices. Add to that some of the cost-cutting initiatives across the sector, and oil stocks actually could rebound in 2021. However, it likely won't be smooth sailing, so the sector could face renewed selling pressure if vaccines don't roll out quickly enough or supplies rise faster than anticipated. Investors should still buckle in for what could be a bumpy ride. So, renewables, the renewable energy sector. Right now, around the world, 940 million people around the world lack access to electricity, and renewable sources of energy are key to achieving a sustainable and equitable future. There's no doubt about that in my mind. The world currently gets about a third of its energy from renewable sources. Prior to the pandemic, 2020 was set to be a record year for new renewable energy capacity, meaning the amount of new solar panels, wind turbines, and other sources of energy installed around the world would actually be significant. But like many other sectors in the energy space, the sector has also been impacted by the global energy crisis. So the International Energy Agency has cited the disruption in supply chains for solar PV, photovoltaics, and wind, because manufacturing facilities were obviously not providing materials at the pace that they should have provided them. But I think in 2021, China will actually be key to continued growth in the renewable energy industry worldwide. Currently, China is responsible for around 70% of all solar photovoltaic panels and is enmeshed in the global supply chain for wind turbines. And China's own pandemic containment strategies have largely proven effective. So local economies have reopened and manufacturing is back somewhat to pre-COVID levels. The other thing to watch out for is the cost of renewable electricity storage, which is continuing to decline. So that's allowing for greater storage capacity with new forms of storage emerging, including flow batteries that have a longer lifespan than your standard lithium-ion batteries. In the past, insufficient storage capacity and poor storage options did limit the potential of renewable energy and were also prohibitively expensive. But I think going forward, the costs of renewable electricity storage are likely to continue to decline, and we're going to see more storage capacity emerge, as mentioned with the advent of these new batteries. It's unlikely that renewable energy as a source of energy can meet humanity's energy demands in the decades ahead by itself. As a result, most countries around the world have to develop mixed energy portfolios that focus on reducing greenhouse gas emissions that cause climate change and enacting what I call degrowth policies that shrink economies and resource consumption in a sustainable way. So the energy mix portfolio will likely include nuclear power in some parts of the world, biothermal energy, and hydropower. Countries are also interestingly increasingly factoring in green hydrogen. It's a type of fuel created by separating separating hydrogen particles from water through a process called electrolysis. When this process is made possible by renewable energy, the resulting hydrogen generates no carbon dioxide. So finally, my parting words, I think globally more and more oil and gas companies will look at diversification into low carbon energy, and more companies will set goals for cutting emissions, especially in the global north. Next, look out for my take on how the global energy transition will shape Africa's energy landscape in 2021. If you like this video and you want to hear more, you can follow me across all my social media platforms, including my YouTube channel at Rolake Akinkugbe, and do subscribe. See you next time.